Most banks are going to want to do an income verification on you when you apply for a mortgage. So these 9 creative ways of buying the house are just basically ways to bypass that income verification on yourself when you want to buy property. The first and obvious way to do this is, of course, just to buy the property with cash. And not everyone's going to have the cash lying around, but of course, when you buy a property with cash, they're not going to do a credit check, they're not going to do an income verification. Because there's no loan, you actually don't even need to do an appraisal on the property. Generally, the appraisals happen because the bank is wanting to make sure that the collateral, that house that you're buying, is worth enough to back up that loan in case you default. And some investors do this. They'll buy a home with cash because they know they can move fast and they can get it below market value, and they can save money on a lot of the paperwork, appraisals and things like that if they're sure of themselves. They buy it with cash, move very quickly, and then once they own it, they go back and refinance that. You could buy it with cash, and as soon as you start working again or your income situation improves, if you want to, you can get a mortgage on that home, and it would be just as if you'd started right off with a mortgage. Another way to do this, though, is to go to the owner and work out something creative with the owner. There's the lease option. The lease option is when you tell the owner, I want to buy this property, but I want to buy it in 3 years or 5 years or whatever you guys agree on. So in the meantime, how much do you want me to pay you to just reserve that right? When that time comes in 3 or 5 years or 7 years, I can purchase for the price that we agree on today. Some owners will be willing to just have you essentially pay like a fair rent for the property, or just handle all their bills. They want out. They don't want to have to deal with paying mortgage payments, utilities, repairs and maintenance. So you handle all that stuff. You pay all that stuff for them, and maybe they even end up with a few $100 after that, and you just say, hey, I'm taking this off your hands, and when the time comes in a few years, I'll buy it for that price. And sometimes the market appreciation in the interim can make it so that you're actually buying it for much less than what it would be worth a few years from now. So just because you offer a price that's more than it's worth today doesn't necessarily mean that when you go to buy it in a few years, you're actually paying above market value for that. And because you worked that deal out privately with the seller of the property, there's no need to do an income verification through a bank. Another thing you can do is to just work out a straight owner financing situation with the seller. And in that case, the seller is going to act like the bank on your behalf. So what happens is when he sells the property to you, you work out an amortization schedule. You work out an interest rate with him. You figure out what the monthly payments are going to be, and you basically just start making payments to him as if you were paying mortgage payments to a bank, except that he may not or she may not require income verification. They might not require an appraisal. They might not require a credit pull. So basically what they care about in that situation is they want to sell the property. They're going to care probably about your down payment, although you may be able to negotiate lower than a 20% down payment. 20% down payment is usually what's required when banks finance a property for you. I did this actually. My first investment property was an 8-unit apartment building. I hadn't been working because I'd been traveling out of the country. My credit was pretty good, but I had no income, and I hadn't had any income for a while. So a bank wouldn't have financed me, but the owner of the property was able to, we were able to work out a seller financing agreement. I paid 12% down, and I was paying, I believe, 6% interest to the owner. And I needed no credit check. I actually decided to, because it was a property that was producing income, I knew how much I thought it was worth. I decided to not go with an appraisal when I bought it, so I saved that money. Of course, I did the inspections and the other things that I would normally do, but instead of making payments to a bank, I was just making payments to that guy, and no income verification required for that one. So another way, now moving along, if the owner just wants to do things the normal way, You can also still bring other people into the mix and possibly even qualify for bank financing. One example is just to have your spouse qualify for the loan. And this is what's going on with me right now. I'm currently on my sabbatical, and I want to buy an investment property. It's probably going to work if my wife applies for the mortgage, and then we're just both going to be on the title of the property. So we're both going to own the property together, the investment property, except her income is going to be the income that's proving to the bank that we're going to be able to pay this mortgage. So I'm not going to have any loan in my name. She's going to have the loan in her name, but the title is going to be in both of our names. We're both going to own the property. Another option here is to bring in a co-signer. A trusted family member, usually. Many friends probably wouldn't want to do that kind of thing. But basically what they do is they come in, they use their income, their credit score and everything, and you guys sign the loan documentation together. With your spouse, you're not on the loan, but you share title. In the co-signer's case, you're going to be on loan with the co-signer. You're both going to be on the loan, but only you are going to be on the title. Another option is to do a joint venture with someone. Maybe you're going to share in the profits from the property. Maybe you're going to share in the equity in the property. Except with a joint venture, the sky's the limit. I mean, you can talk to people whatever that they feel like doing, and you feel like doing together. You guys can agree on that, and that can be that. You pay for the down payment. They secure a loan for the other 80% of the property, and then you split the profits. Or maybe you come with experience, expertise, you advise them, and they're just going to go ahead and buy the property as if it was theirs, but now you share in the rental income from the property. You can do many things with people there, but the main thing is you're staying out of the financing in that case, and you're still going to have a stake in this investment property. And in that case, you can finance it with a regular bank, because they're not going to be doing an income verification on you. Same with a co-signer, same with having your spouse do it. These can all be financed through a regular bank. The point is that the income verification won't be done on you. You can use another lender besides a bank. Some examples of that are taking a life insurance policy loan. If you have high cash values in your life insurance policy, you can go ahead and take a loan from there to buy the house. In this case, the house is not collateral, which could be a plus in some situations. For example, when the house is collateral and you default on the loan, they take the house. That's why the appraisal is so important. In the case where the house is not collateral, people who loaned you money don't have any claim to that house. You can create your own payback schedule. You could pay interest only if you want, and some of that stuff can be very appealing to people, and the home is not the collateral for that loan. No credit check, no income verification to do that. So you would be on title, you would have a loan, but the loan wouldn't be against the property. Another option is private money lenders or hard money lenders. Now, these guys usually they're people who want to make a return on their money. They can lend money. Usually it's for short periods of time at high interest rates. And these guys are wanting to kind of churn their money into a bunch of different deals and make high interest rates over a short period of time at the top end of that curve, where you're paying down your mortgage. At the very beginning, most of it is interest. So they're trying to get that beginning there where they're getting a lot of interest there on a high balance. And so you may have to refinance the property with a bank or in some other way within a year, 2 years, 3 years, 4 years. It depends on the hard money lender. But one thing about this is that it's an asset-based loan. So if the property, for example, if you're going to do a flip on the property and they know what the after repair value is, they may lend you a certain percentage of that, 75, 80% of that after repair value. What they expect you to do now is they expect you to go in, fix up that property. So you bought it at a certain price, you borrowed a certain amount from them, you bought it at a certain price. Once you fix it up, you've gained a lot of equity in that property. So when you refinance the property, you should be able to get back all the money that they lend you, and you pay them back. Now you just owe a mortgage on that property. So In that case, the home is the collateral. One of the benefits is that you may not have to do a credit check or a income verification for yourself in order to get that kind of loan. Another way to do it is using a revolving line of credit that you have, which could be secured or unsecured. So I'm talking a personal line of credit, home equity line of credit on your residence, even a credit card. In this situation, you're going to have probably pretty high interest rates. If you max out a line of credit, for example, it could hurt your credit score, or a credit card, it could lower your credit score until you pay that balance off. If you already have the line of credit, or you already have that credit card, there won't be any other credit check or income verification. You have a house, a situation where you're doing a joint venture and you need to come up with the down payment, for example, and then they qualify for the mortgage. Well, maybe you could get $20,000 out of a personal line of credit. And the $100,000 property, well, the $20,000 is the down payment there. So you could buy the house without you could go into a joint venture with someone who can qualify, and you wouldn't necessarily have to be talking to the bank and proving your credit score or your income or anything else like that. So that's just an example. If you have credit cards, home equity line of credit where you can access that. If you have a large enough line of credit, you could buy the house outright. And if you start working again, refinance at a much lower interest rate and get a conventional mortgage. These are all ways that you can basically avoid the income verification when you're going to buy a house or an investment property. I hope this helps. I hope it's interesting. Stay tuned. I'm going to be making more videos about my financial ideas. The videos will get better, I promise you that, as I learn more about how YouTube works. If you like this video, please hit the like button. I know that's supposed to make a big difference. Okay, thanks a lot, and see ya.